In the alternate version of Quick Study 9-5, we're going to record employee liabilities. On January 15th, the end of the first biweekly pay period, North Company's payroll register showed its employees earned $25,000 of sales salaries. So I'm going to skip some detail for now and look at our overall objective, and that's to accrue North Company's January 15th employee payroll expenses and liabilities. The key term is their accrue. What that means is we're not yet paying the employees, but we do need to record the expense and the resulting liability related to it. So let's start building our journal entry on January 15th. A logical starting point is to record the total cost or expense with a debit to sales salaries expense. Keep in mind it's related to sales salaries. The total cost or expense is going to be debited for $25,000. Now you recall that I said we don't yet pay it, so we can't credit cash. So you think our next step is to go ahead and credit salaries payable for $25,000 because we need to show the liability that we eventually owe this to the employees. Well, I wish it was that simple. There's going to be various withholdings or deductions that are going to create a difference between a $25,000 total expense or cost and what the employees actually take home as far as the salaries payable. Some of them are going to be considered involuntary deductions, so you may have various taxing agencies or different government authorities, different agencies like FICA for Social Security and Medicare, or federal or state governments withholding income taxes. You might also have voluntary deductions, so things like medical insurance premiums or life insurance and premiums that the employee asks the employer to deduct from their wages and remit on their behalf. Those are all going to create a difference between the total expense and the amount the employees are actually going to take home. Now, whether the employee has asked the employer to do it or it's mandated, this is a liability or obligation to the employer, North Company, until the time at which they pay it. So those different deductions or withholdings are going to be recorded as various payable or liability accounts until the point at which they pay it. So let's start to read through which items apply in this situation. The withholdings include FICA Social Security taxes of 6.2%. So again, we said that's going to be a liability, so we'll credit FICA Social Security taxes payable. Remember, payable indicates liability. What amount do we credit it for? We're going to have to take our $25,000 total expense times our rate of 6.2% to get a total credit of $1,550. FICA Medicare taxes are deducted at a rate of 1.45%. So we'll credit FICA Medicare taxes payable. You'll see a consistent payable indicating liability at the end of each of these accounts. We'll take $25,000 this times 1.45% for a total credit of $362.50. It also indicates that, again, involuntary deduction, federal income taxes. So we'll credit employee federal income taxes payable. This time we don't have to calculate. They tell us directly the credit's going to be $5,500. That ends our involuntary deductions. Voluntary deductions included medical insurance deductions. So we'll credit employee medical insurance payable for $675.50, and also union dues. So we'll credit employee union dues payable for $95. Let's keep reading through our scenario. Our FUTA taxes, which is federal unemployment taxes, are at a rate of 0.6%, and SUTA, or state unemployment taxes, are 5.4%. It does indicate there's a cap that's only paid on the first $7,000, and there's also a caveat here that says we don't have to worry about that cap because no employees actually earn more than that. So we just keep chugging through like we did for Social Security, take our $25,000, multiply it times 0.6% for FUTA taxes, and credit federal unemployment taxes payable for that total dollar amount? No. Keep in mind that unemployment taxes, no matter if they're federal or state, are not withheld or deducted from the employees. That's an important distinguishment. Sometimes you may be given additional information that doesn't relate to the particular journal entry that we're recording. Unemployment taxes are not a deduction or withholding. They're an additional expense of North Company, but not a deduction from the employee's wages. And we'll have another journal entry and another problem where this will come into play. So we've got our total deductions, and what we're going to do is finally record our credit to our salaries payable, because keep in mind we're not yet paying it, so we can't credit cash. What dollar amount do we use? We're going to take our total expense of $25,000 and subtract all our various deductions: $1,550 for Social Security, $362.50 for Medicare, $5,500 for federal income taxes payable, $675.50 for medical insurance, and $95. Subtracting out all those deductions gives us a total credit or liability at which we owe our employees of $16,817. That's also called net or take-home pay, and that's an important thing. You may be asked to calculate what's the total net pay. What that means is that's the total dollar amount that those employees are actually going to be able to take to the bank. Another question you could possibly be asked, but it's not included in this particular problem, is what's the journal entry we use to record the actual payment of wages? So what we would do is we debit our salaries payable. Keep in mind, it's a liability account. We decrease it with a debit for $16,817 to record payment to the employees, and credit cash for $16,817. And that at least records the employee portion of payroll.